American banks legally extracted $11.68 billion in overdraft fees alone last year. That's billion with a B, from people who literally didn't have money in their accounts. But overdraft fees? That's just the appetizer. I'm Alex, and I just spent the last week reading bank earnings reports, Federal Reserve data, and Consumer Financial Protection Bureau complaints. And what I found is a systematic wealth extraction machine hidden in plain sight. I'm about to reveal 10 ways your bank is legally stealing from you. Some of these you know about, some you suspect, but the one I'm saving for number 10, that's the nuclear option. The one that's costing you thousands without you ever noticing. If you've ever looked at your bank statement and felt like something was off but couldn't quite put your finger on it, the next 10 minutes will show you exactly where your money is going, and more importantly, how to stop it. But here's the thing, the first three fees are obvious. Everyone knows about them. It's fees 4 through 7 that most people miss. And fee number 10 is so egregious that when I explain the math, you're going to question why you still bank where you do. Stick with me, because after number 5, I'm going to tell you the exact banks that don't pull this garbage. But first, let's start with the one everyone knows but nobody understands how deep it goes. Quick heads up. If my AI voice sounds slow, bump this to 1.25 times speed. Trust me, you'll want to hear all 10 of these, because by number 7, you're going to be genuinely angry. Let's go. Number 1, overdraft fees. And the criminal part isn't the fee itself, it's how they engineer the overdraft. You have $100 in your account, you buy coffee for $4, lunch for $12, gas for $30, then you forgot about that $80 subscription that auto drafts today, you're $26 over. Normal math says you get one overdraft fee on the subscription, but here's what banks actually do. They reorder your transactions, they process the $80 charge first, even though it happened last. Now your account shows $20. Then they process the $30 gas charge, overdraft fee, then the $12 lunch, another overdraft fee, then the $4 coffee, third overdraft fee. Same transactions, 3 overdraft fees instead of 1. At $35 per fee, that's $105 in fees on a $26 overdraft. This transaction reordering is 100% legal, and it generates billions annually. Wells Fargo alone was making $1.4 billion per year from overdrafts before they got sued enough times to stop some of the worst practices. But here's where it gets darker. Some banks have a feature called overdraft protection. Sounds good, right? Wrong. They're charging you $10 to $12 every time they transfer money from your savings to cover an overdraft. You're paying them to use your own money. The fix? Opt out of overdraft coverage entirely. Let the transaction decline. The embarrassment of a declined card is free. The fee is not. But overdraft fees are just the entry-level theft. Number 2 is something 72% of checking accounts charge, and most people don't even realize they're paying it. Number 2, monthly maintenance fees. Banks charge you $12 to $15 monthly just for the privilege of them holding your money. That's $144 to $180 per year to access your own funds. Now they'll tell you it's waived if you maintain a minimum balance, usually $1,500 to $5,000 depending on the bank. But here's the scam within the scam. That minimum balance requirement forces you to keep money in a checking account that pays basically zero interest. The national average checking account interest rate is 0.08%. That's not 8%, that's 0.08%. Meanwhile, inflation is running at 3.4%. So your $5,000 minimum balance is losing $170 in purchasing power every year just sitting there. The bank isn't just charging you the $15 monthly fee you avoided by keeping the balance. They're also profiting from the interest they earn by lending out your $5,000 while paying you essentially nothing. It's a double skim, and it's completely legal, but at least maintenance fees are visible on your statement. Number 3 is something you only notice when you're traveling or in a pinch, and the markup on this is genuinely offensive. Number 3, ATM fees. Use an out-of-network ATM and you get hit twice. Your bank charges you $2.50 to $3.50 for using someone else's ATM. Then the ATM owner charges you another $2.50 to $3.50 for the same transaction. That's $5 to $7 to withdraw your own money. On a $40 withdrawal, that's a 12.5% to 17.5% fee. Americans paid $4.7 billion in ATM fees last year. Think about that. Almost $5 billion just to access cash that already belonged to them. But here's the part that should make you furious. It costs banks approximately 36 cents to process an ATM transaction. They're charging you $3.50 for a service that cost them 36 cents. That's an 872% markup. And if you travel internationally, Buckle up. Foreign transaction fees run 3% on ATM withdrawals, plus the flat fee, plus the exchange rate markup. You're paying 5% to 8% total to access your money abroad. Now, those first three are obvious. Everyone knows about them. They're annoying but visible. The next seven are where banks really get creative. And number four is hiding in plain sight on 62% of savings accounts in America right now. Quick question. Drop a comment. How much does your bank charge in monthly fees? And do you know if you're actually avoiding them or just think you are? I'm curious what people are paying. All right, here's where it gets sneaky. Number four, savings account interest rates that don't beat inflation. This is the theft nobody talks about because it doesn't feel like a fee. The average savings account in America pays 0.46% interest. Inflation is 3.4%. That means your savings account is losing 2.94% in purchasing power every year. You save $10,000. Your bank pays you $46 in interest, but inflation costs you $340 in purchasing power. Net loss, $294. Meanwhile, your bank is lending that $10,000 out in personal loans at 11% to 12%, mortgages at 7%, credit cards at 20% plus. They're making thousands on your money while paying you essentially nothing. This is legal wealth transfer. You give them $10,000. They pay you $46. They profit $1,100 to $2,000 on your deposit. You lose purchasing power. High-yield savings accounts exist that pay 4.5% to 5% right now. But big banks don't offer them because they don't have to. Inertia keeps you there. But at least savings accounts are optional. Number five is something that hits you when you're trying to do the right thing financially. And the audacity of this fee will genuinely shock you. Number five, paper statement fees. Banks now charge $2 to $3 monthly if you want a physical record of your transactions mailed to you. Let me say that again. They charge you money to provide documentation of how they're handling your money. This used to be standard, free, part of the service. Now it's $24 to $36 annually per account if you want paper statements. But here's the real scam. Going paperless isn't about saving the environment. It's about reducing your documentation. When statements only exist digitally, they're easier to lose, harder to reference, and the bank controls access. If there's ever a dispute about a transaction from 8 months ago, good luck finding that digital statement you forgot to download. But the bank has it, and they'll charge you to retrieve archived statements if they're old enough. This is a fee for accountability. They're charging you for the paper trail that protects you from their mistakes. Now we're halfway through, and I promised you at the start that number 10 is the nuclear option. But before we get there, number 6 is going to make you check your last 3 months of statements immediately, because this one only shows up when you're trying to do something completely normal. Number 6, wire transfer fees. Need to send money? Banks charge $15 to $30 for domestic wire transfers. International wires, $40 to $50. The actual cost to the bank? Functionally, zero. It's a database entry, a digital transfer that happens in seconds. But they charge you like they're physically transporting gold bars. Here's the kicker. Services like Zelle, Venmo, and Cash App do the same thing instantly for free. But banks still charge you $25 to wire money because corporate clients and real estate transactions still require wires. They have a captive audience. Wells Fargo makes over $150 million annually just from wire transfer fees for database entries, but wire fees only hit you occasionally. Number 7 is a poverty trap that banks set for people who can least afford it. And when you hear how this works, you're going to understand why 63 million Americans are unbanked or underbanked. Number 7. Minimum balance fees combined with low balance alerts. This is predatory by design. If your account drops below $300 to $500, some banks charge a $5 to $12 monthly low balance fee. You're being charged for being poor. But here's the trap. They send you low balance alerts. Your account is below $500. You think, okay, I need to deposit money. But before you can, they process pending transactions. Your balance drops further. They hit you with the low balance fee. Now you're even more in the hole. This creates a debt spiral for people living paycheck to paycheck. The fee makes it harder to get above the minimum, which triggers more fees, which makes it harder to recover. Chase eliminated low balance fees in 2021 after public pressure, but hundreds of regional banks still charge them, and they disproportionately impact people making under $50,000 annually. It's a tax on being broke, and it's completely legal. Now you're probably thinking these fees are bad, but at least you see them on statements. Number 8 is invisible until you read the fine print. And when I tell you what triggers it, you're going to realize you might have been hit without knowing. Look, if you're getting angry at your bank right now, good. Hit subscribe because we expose financial systems designed to extract wealth. Capital Theory doesn't sugarcoat this stuff. 3 more to go. And number 10 is the one that's costing you the most. But first, number 8. Number 8, early account closure fees. Open a checking account to get a sign-up bonus. Great. But if you close it within 90 to 180 days, the bank hits you with a $25 to $50 early closure fee. This isn't disclosed up front. It's buried in the 40-page terms and conditions you didn't read. The scam? Banks offer attractive sign-up bonuses to lure you in. $200 to $300 for opening an account and meeting certain requirements. But they're betting you'll either forget about the closure window or decide the hassle isn't worth it. If you close early, they claw back part of the bonus through the closure fee. If you stay, they've captured you as a long-term customer paying all the other fees we just covered. Credit unions typically don't charge these fees, but major banks, it's standard practice. Number 9 is something that hits older account holders and people who maintain multiple accounts. And the cruelty of this fee is that it punishes you for not using the account they're charging you to maintain. Number 9, inactivity fees. Don't touch your account for 6 to 12 months. Some banks charge $5 to $10 monthly for inactivity. You're being charged for not using the service you're already paying maintenance fees for. Read that again. This typically affects people who opened accounts for specific purposes. A savings account for a future purchase. A checking account at a regional bank before moving. An old account you forgot about. The bank isn't providing any service. They're just extracting fees from dormant accounts, betting you won't notice until months later. Some states have laws requiring banks to turn over dormant accounts to the state after a certain period. But before that happens, banks will bleed the account with inactivity fees. The fix is to close accounts you're not using. But remember number 8? They'll charge you for that too if you're within the closure window. Alright, here's number 10. And this is the one I promised you would make you question everything. Because this isn't a fee you see on your statement. It's a mathematical theft that happens in broad daylight, and it's costing you thousands. Number 10, negative real returns on checking and savings accounts while your deposits fund high interest loans. Let me break down the math that banks don't want you to understand. You deposit $20,000 split between checking and savings. Your checking pays 0.08%. Your savings pays 0.46%. Combined, you earn about $96 annually. Inflation at 3.4% costs you $680 in purchasing power. Net loss, $584. Meanwhile, your bank takes your $20,000 and lends it out multiple times through fractional reserve banking. They're required to keep 10% in reserve. The other 90% gets lent out. Your $20,000 becomes $18,000 in loans. At an average of 10% interest across credit cards, personal loans, and mortgages, the bank makes $1,800 annually on your deposit. You get $96. They make $1,800. You lose $584 to inflation. They profit $1,700 plus on your money. This is the core business model, and it's completely legal. You're subsidizing their profit margin while your wealth erodes. But here's what makes this theft. High-yield savings accounts pay 4.5% to 5% right now. That same $20,000 would earn $900 to $1,000 annually, enough to beat inflation. Those accounts exist, but big banks don't offer them because they don't have to. Inertia, brand loyalty, and convenience keep you depositing money at 0.46% while they lend it at 10% to 20%. The wealth transfer from depositors to banks is billions annually, all legal, all disclosed in dense terms and conditions nobody reads, all hidden behind the convenience of the bank on every corner. So, what do you actually do about this? I'm not going to leave you angry without solutions. First, switch to a high-yield savings account for your emergency fund. Markets by Goldman Sachs, Ally Bank, American Express Savings. They pay 4.5% to 5% right now. That's 10 times what your big bank pays. Second, use a no-fee checking account. Capital One 360, Ally Discover. 0 monthly fees, 0 minimum balance, free ATM networks. Third, Opt out of overdraft coverage entirely. Let transactions decline. It's free. Fourth, use Zelle or Venmo for transfers instead of paying wire fees. Same day, zero cost. Fifth, set one low balance alert and close accounts you don't use before inactivity fees kick in. And here's the big one. Stop thinking of your bank as your financial partner. They're not. They're a for-profit corporation extracting wealth through fees and interest rate arbitrage. Treat them accordingly. Here's the truth. Banks aren't evil. They're businesses. But the game is rigged in their favor. And the only way you win is by understanding the rules they don't advertise. $11.68 billion in overdraft fees. $4.7 billion in ATM fees. Hundreds of billions in negative real returns. This isn't accidental. It's the system working exactly as designed. Your job is to opt out of the parts that cost you and optimize the parts that work for you. If this opened your eyes to where your money is actually going, subscribe to Capital Theory. We expose the financial systems designed to extract wealth, not build it. Drop a comment. Tell me which of these 10 fees you've been hit with. And if you're switching banks after watching this, I want to know where you're going. Next video drops in 3 days. We're breaking down the Chinese savings system that lets families save 10 times more than Americans. You're going to want to see that. Stay smart. I'll see you in the next one.